Will there be another rate rise next week at the November RBA board meeting? You would not believe it. As of Friday, November 3, just a few days before the meeting, it's a 50-50 call. You can flip a coin to work out whether rates are going to rise or not. Or if you want a more sophisticated analysis, keep watching and we're going to run through how the Australian economy is responding to higher interest rates and what the RBA are going to be considering when making their decision to raise or pause. It's a very finely balanced decision. You can make an argument either which way to raise interest rates because inflation's a little bit too high off their scheduled pathway and they're losing some patience and tolerance for inflation being just too high for too long. Or you can make the other argument and say Australian households are feeling the pressure. We're in a GDP per capita recession already, and we can simply be patient and let inflation continue to come back down because inflation is coming back down, just not quickly enough. Should we just wait, pause, and see how it goes in 2024 before raising rates further, given we've done all of these rate rising already and so many Australians are already feeling the pinch? That's what they're going to be mulling over. If you're interested in this, hit that subscribe button, hit that like button, and follow me on my journey to help educate Australians about how property, housing markets, and the Australian economy at large work. Hi, I'm Reedham Syed, founder of Confidence Finance, property investor, 5 times top 100 mortgage broker in Australia, and ex-Treasury economist. Let's go through it. This call is very, very close. This is what the major bank economists are predicting. What do you see? Everyone is predicting an interest rate rise. I can understand that. On our side, the sentiment that we're feeling is one of urgency on the housing market. Lots of people are seeking lending, and when so many people are feeling confident enough that they want to go buy a house, you get a little bit of a sense that, hey, maybe interest rates haven't risen far enough to alter the confidence and psyche of Australians to slow the economy down, which is what the RBA need to get inflation back down. We also have new car sales in the month of October reaching all-time highs. That's crazy. Interest rates have gone up so much, yet people are buying more cars now in the month of October than ever before. That sort of sentiment is part of the reason why the RBA are actually re-questioning and recalibrating. Have we increased interest rates enough to slow this economy down? I can certainly understand it because our pulse and sentiment is suggesting perhaps they do need to increase interest rates further. But let's go through the data. The number one reason why they will be increasing interest rates at its meeting is because inflation is too high. It was the biggest data piece that's come out in the last couple months and the one that they've been waiting for before really making another decision point. At the end of this month, they're going to come up with a new trajectory for how inflation is going to track over the next few years and release their forecast. And it's going to show that inflation is higher than their current forecast amounts. In the past 3 months, inflation profile has come in higher than what they're willing to accept, and they're losing patience for inflation being too high. One of the reasons for this is because of inflation expectations and our psychology. If we all think inflation's going to remain really high above that 3% benchmark that they have, the top end of their band, for an extended period of time, then businesses will adjust their pricing. And businesses are responding to actual inflation data and the prices of goods and services and the costs they pay. If it's rising and it's continually rising and past that 3% benchmark, then their expectations get anchored that that's where inflation is and they adjust pricing accordingly. Meanwhile, households, workers, etc., everyone goes and asks for pay rises to be above inflation, and that's creating this sort of vicious cycle that keeps inflation hanging around. That's why central banks need to kind of beat down the economy a little bit and slow it down enough to adjust the expectation theory that we have. And inflation expectations is one of the main drivers of inflation itself. When you split this out, inflation came in at around 1.2 to 1.3%, depending on which measurement you use, and it needed to come in below 1%. So a little bit above the pathway that they have in mind. So the pathway looks a little like this now. It's off track a little bit. The black line shows where inflation actually is, and that gray line here is what the RBA forecast profile is. Now you can see it right now. We have a subtle uplift where that black line is ahead of that gray line. Cricket fans out there, you'll be aware of this when you're chasing run totals. This is what it looks like. We're a little bit behind. Australia is behind on our inflation fight, and the RBA have already set these benchmarks pretty low. Like, they've come out saying, hey, we're going to take 2 years to bring inflation down, a little longer than all the other global economies and central banks all around the world. And yet we're still past that pathway. Will we remain past that pathway or not? Will we catch it up with interest rates at its current level, or do we need rate rises to kick in to be able to get us back down to this grey line, or beat this grey line, which is really the ultimate aim of the RBA at the moment? So when you unpack inflation itself, this bit perhaps is a little bit positive, because the main driver of that 1.2 to 1.3% is actually automotive fuel. You notice this when you go to the Bowser. I went there today, and my God, petrol prices are ridiculous at the moment. I paid $2.30 to fill up my car. Perhaps I should have shopped around and managed to get it down a little bit, but $2.30, it was $1.80 not too long ago, and that's a huge change in the price of fuel, and fuel prices impact a whole range of other things. When you go to the supermarket and you go buy some fruits and veggies, the trucks that go and drop them there, they're using fuel. If you go buy some furniture, they're using fuel. If you go buy anything, really, any good out there, it's quite likely that it's impacted by the price of fuel too. And there's even more uncertainty about fuel prices given what's going on all around the world at the moment, and the potential impact on petrol prices, on the raw petrol price that we get from the Middle East when there's conflict happening there. Who knows what's going to happen to petrol prices there, but that creates further uncertainty, and it may mean petrol prices continue to rise, and that causes inflation to stick around while the RBA is trying to beat it down. Bit of a problem. You also have inflation coming in from rents and new dwelling owner-occupied purchases. So that's construction costs. They're the main drivers of inflation here, as well as electricity and some restaurant meal expenses too. So if you break those down, do interest rates really bring rents down? I do not believe so, and I don't think the RBA are fully committed on that. I think they recognize that when rates go up, rents can actually rise too, because landlords have pricing power at the moment with such low vacancy rates all across the country that they simply pass that increased cost on when they can. So you have fuel, which interest rates have pretty much no bearing on, very, very minimal bearing on. You have rents. Interest rates may even have a negative bearing on. And you have new dwelling construction costs, which have come down a lot recently, and this data is just showing a little bit of a lag in construction costs feeding through to CPI. Construction costs have come down recently, and in future data releases, it should start tracking down more and more, and this is just the last little bit that's been pumped into the CPI data itself. Electricity prices have gone up. Electricity prices are somewhat regulated, with price increases occurring in this quarter on 1 July usually kicking in. So that's why electricity prices seem to have a higher weighting in this CPI result. And I suspect that may come down in future quarters because the main electricity rise occurs in this quarter itself. So that's the breakdown of inflation. And when you look at the breakdown, it's somewhat encouraging in the sense that, hey, interest rates itself are slowing the economy down, but there's all these other factors that the RBA don't have too much control over that's driving inflation up. The problem here is the expectation theory that I mentioned, and their lack of patience now. They're just sitting there being like, look, I'm not comfortable with inflation being above my, softy benchmarks that I've already set. It's above those soft benchmarks. Really, I got to get it down. I got to act, and I got to bring inflation down by increasing interest rates. That's kind of their thinking at the moment. Second reason why they can increase interest rates is when you look at the employment market. I've got a little chart of it here. It's still pretty strong. Australian unemployment rate is at 3.6% at the moment. It came down this last month from 3.7 to 3.6%. Overall, employment market's pretty strong and in line and beating the RBA's own projection a little bit. So that provides them comfort that, hey, the employment market can withstand higher interest rates so far. But on the flip side, you can actually look at this data the other way around and say, look, the employment market's clearly at a turning point. Interest rates are now feeding through to the labor market. Perhaps we just need to pause and let this continue to play out. So the data here is a little bit mixed because you can read it in both ways. Clearly, the Australian economy is showing resilience to all these rate rises so far, but will it continue to do so because the employment market is turning around? And that's what they wanted to see a little bit. So that's showing up in the data now. I've highlighted in red here. So the third reason why they will increase interest rates is when you look at GDP data overall. Now, we are in a GDP per capita recession, but there's so many new people coming into Australia at the moment. We have a net migration boom happening, and that's driving inflation, and it's also driving growth in the Australian economy at the moment. When you bring in so many people in the short term, what you have is those new entrants go buy things. They buy new cars, which we've seen. They potentially build new homes, they rent new dwellings, etc. So that creates demand in the economy in a little bit of an upfront sort of way. So imagine, you move to a new country, and in your first 6 months, you're probably going to be buying furniture, buying a rental accommodation or a house to live in. You're buying a car. So you're buying lots of things when you first move into a country. And we are seeing that feed through, and it creates additional demand. And we're seeing that in the GDP data, where GDP data is performing stronger than the RBA's profile as well. Per capita, though, when you strip that bit out and you just put it per person, per Australian, we're moving backwards. So on that end, it's not so positive. Our retail data, one thing that we do look at is to look at retail spending to track how the Australian economy is performing. It had its biggest lift in 8 months in this data release. So overall, we have a whole range of data sets suggesting positive factors about the Australian economy and about the global economy a little bit too, that suggest, hey, perhaps we can increase interest rates. All this new data is suggesting that things are going a little bit better than expected. Perhaps we need to raise rates. Another big anomaly that's happening is house prices, not just in Australia, but all around the world. If you look at this, the housing market, the global housing market, so to speak, has hit a turning point, and house prices are rising everywhere. In Australia, it's quite obvious. House prices have risen nearly 10% this year, at least in Sydney and in our major capitals, and that turning point happened at around February. This works contrary to the interests of the RBA. When house prices rise and people feel richer as a result, they may go and spend more. When that happens, inflation stays around for longer and it's harder to beat. So that's another little pulse for how the Australian economy is responding to all these rate rises. There you have it. Those are the main reasons why the RBA will increase interest rates. It's centered around the data coming in strong. Inflation strong, employment strong enough, house prices strong, GDP growth strong. All these indicators suggest we can absorb further rate rises. Will that mean one rate rise? Could it possibly mean two, or maybe even more? That's getting into the scary zone when you think about interest rates being like, wow, we're at 4.1% already. So many borrowers have already been pushed to their limits. And now the data about the Australian economy is coming in strong. That could suggest we need another 1 to 2 rate rises before reassessing again. And that's going to put some households on the brink into that deep red zone, into negative cash flows. That's a little bit of a concern for those households. On the flip side, let's look at the other side of the coin, the tail side here, and work out why they will pause interest rates again. Why is it a 50-50 decision? This all comes down to the word outlook. Has the outlook for inflation changed? Bygones be bygones, the data is in the past, and that past data suggests that, hey, we haven't really hit the inflation profile we were after back then in September, but has our inflation trajectory of beating inflation by the end of 2025 and in 2024, has that altered from the recent data that has come in?
I'm not prepared to say yet whether or not it's a material change to our forecast, because there is going to be a change to our forecasts.
That bit is unclear. The RBA itself have chosen these words. The board will not hesitate to raise the cash rate further if there is a material upward revision to the outlook for inflation. At the same time, the RBA is mindful that growth in demand and the rate of inflation have been moderating and that there are long lags in the transmission of monetary policy. Has there been a revision to the outlook for inflation? I cannot say that with certainty because you can make the argument, bygones be bygones, that data is in the past and it doesn't impact the future data for inflation. How strong that argument is questionable, but we do have some insight from the Treasurer himself. When the data came out, the Treasurer himself made his own press conference and he would have had a phone call and a briefing from the Treasury Secretary who sits on the RBA board, and potentially the RBA governor herself may have picked up the phone and spoken to the Treasurer about the data on the day. I think she was in Canberra in and around then, so it's quite possible they did have a meeting and have a quick little discussion about the inflation data. And this is what the Treasurer said, re the outlook question. The Reserve Bank will look for material changes to the inflation outlook. What we've seen today, and they will obviously assess the numbers in their own way, but what we've seen today is consistent with our expectations. It does not materially alter the outlook for inflation. The Treasurer is saying that there has been no change in the outlook for inflation from this latest inflation data. Does that mean the RBA will have the same opinion? And if they do, will they decide to pause interest rates because there's been no change to that situation? They don't need to have an upward revision to interest rates because there's been no change or material change in the outlook for inflation. That's what it's going to come down to, the outlook. What does the outlook look like for 2024 and 2025? And does this new data information that's come out over the month change that outlook? It's pretty finely balanced, and that's why it is a flip of a coin. There's a couple other reasons why they can pause rates, and this is how they will justify it. The economy is clearly slowing down. The employment market is at that turning point. They want to see more data, a bit more time, a little bit more information to come out to see, hey, is it a soft sort of landing, or is that turning point going to be an aggressive sort of turning point, and have they dialed it up too far? GDP per capita is moving backwards. Retail sales, while it's increased in the last month, fairly weak overall on a per capita basis at least. And realistically, inflation is only a little bit above that guide. So if you go back to the chart that I showed earlier about the profile of inflation, yes, the black line is ahead of the grey line, but it's only a tiny little bit for now, and it's only one data point. Perhaps they need a couple more bits of information, and perhaps the February quarter data that comes out for quarter that we're in at the moment comes out in February. Perhaps they would need that information before making their next decision as to whether they raise or pause. So there you have it. You can increase interest rates because inflation came in too high and the Australian economy is showing some resilience, or you can pause interest rates and justify it by saying that the outlook for inflation has not changed. That's why it's a flip of the coin. I'm going to go with an interest rate rise is more likely than not and follow the major bank economist's prediction, but you may as well just flip a coin and decide from there. Presented a whole range of information. We'll find out at 2:30 p.m. next Tuesday.